everyone, hopefully the week's gone well. You're all enjoying the heat. Took some time off for a little bit just from these market updates as I was spending some time with the family, but nice to be back and wanting to help you guys get as much business as possible. One thing that I wanted to make a comment on today, as I've noticed it's come up a lot more from clients recently, is questions about credit bureaus and credit pulls. Now, for reference, I do about 200 credit pulls every single month. And the thing with the credit score is that most people think that if you get your credit pulled from multiple different mortgage agents or banks, that your score is going to go down. This is one thing that I wanted to make a point of, because when getting a mortgage, if your credit is pulled via a similar channel, whether it be me as a mortgage broker, as well as the branch level mortgage agent, the credit score will not go down. So if ever you have someone that's looking for a second opinion, they can do so confidently while still retaining their credit score. The other point that I want to point out is that if someone is really concerned about their score ever going down, most people don't realize that you do get those points back that you lose from a hard credit check, typically over a 2-month time frame. I've also attached a link from Equifax to give you more insight into credit bureaus and what happens when you do credit checks, just so that you're able to answer client questions a little bit more confidently. A little bit further insight into credit scores and why your score does go down when you have it checked is it's not to prevent you from seeking debt. It's actually to protect you if your identity was compromised. If you think about it, if your identity was ever compromised, the person that would have taken your identity or tried to is probably going to get as many credit applications as possible, because the reality is that for credit cards and lines of credit, they'll typically give that out to anyone with a pulse. Now, in these examples, if you had multiple checks for those types of applications, like a credit card or a line of credit, your score would continue to go down every time it's checked. So the thought process behind protecting your identity is if it was compromised and someone put out 20 applications for fraudulent credit cards, by the first 10 would probably get approved just based on the score alone. But by the 11th, the bank or the lender in this case would probably start to do a little bit more due diligence due to the lower score and ask for income verification, which they likely won't be able to provide. So that is why your score goes down whenever you do multiple checks. Elephant in the room, which is interest rates, which have continued to balloon and go higher. We saw fixed rates this week jump significantly higher. There's some institutions that actually change their rate 2 times in a day, which I haven't seen in the last 5 years. With this, obviously cost of borrowing is going up, and the thought process is there will be another rate hike next week. In a perfect world, this is the last one, and then this could be something in which that we could use to inform our clients that this is the opportunity. They should probably try and get into the market on a short-term rate, due to the fact that once they do inevitably start to come down, there's going to be a flood of people coming back and home prices will likely go up. So we're going to be watching very closely next week to see what the Bank of Canada does, and we'll have a good update for you to break all that down after the announcement and the implications it's going to have potentially on the market. One article I found very interesting this week, but also sad at the same time, is the Financial Consumer Agency of Canada is now starting to make a recommendation to the financial institutions that they should give some relief to people that are under duress when it comes to mortgage payments. This could be done by way of waiving any penalties, allowing them to extend the amortization, or renegotiating their rate. When you look at this, this is almost unheard of. It comes to waiving a penalty on a mortgage if you were to move to a different financial institution to get a better interest rate. If this is something that passes, this is a great opportunity for all of us to go back to clients and see how they are currently sitting when it comes to their financial position, because there's the opportunity that we can move them to a different lender at a lower rate without the typical high costs that come with changing institutions. I've been doing a deeper dive and looking for more information when it comes to inflation, because that is the one thing that it seems like the Bank of Canada is trying to battle by raising interest rates. And the one thing that's jumped out at me is the biggest contributor right now to inflation is actually mortgage interest rates. If you were to strip out interest costs when it comes to mortgages out of the CPI, our actual year-over-year inflation right now would only be 2.5%, which is exactly in line with where the Bank of Canada wants inflation to be. What this tells me is the fact that they've hit their mark when it comes to raising rates, and now if they really do want inflation to be tempered, after this next increase that we expect next week, there will be a time where they will hold it, but eventually it will come down. And the way to think about the prime rate and the way that they move it, typically it's like a roller coaster. It goes up slowly and then it comes down very quickly. because they more often than not overshoot the mark and they raise it too much. Now, in this case, because they've raised it so fast, it really is something where we haven't seen the true impacts of these increases yet, because the data they use is based off lagging indicators, it's called. And so if they did overshoot the mark, rates come down very quickly. I do think that the fact that there still is not enough homes in Ontario specifically, that you're going to see prices go up. And I think that that's something when you talk to clients, that can be a way in which that you help prepare them for the idea of maybe getting into the market now when rates are a little bit higher. But ultimately, the goal when talking to clients today is to be managing payments for these purchases that they're making, and the interest rate should not be the focus. Everyone cares about how much it costs to own a home. That is what we try and provide them when it comes to insight and education. And by taking that into consideration and educating them properly, we find that they are a lot more comfortable despite where the rates are. Hey everyone, Miranda says I've gotten fat, so if you think that that's the case,
I'm not a body shamer.
Please respond via email and say you are fat, because maybe that'll motivate me to start working out again. I appreciate you all, thank you.